Hello, everyone. Welcome to the Financial Thing live stream. It is Thursday, July 24th, 2025. Live here from sunny and very humid and hot. I think it's 1,000 degrees centigrade and Fahrenheit here in Orlando, Florida. It is hot, 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 like the song said. Feeling hot, hot, hot. I wish it was cool. I wish it was rainy, but it isn't, alas. Choices we make. Hope you are having a really wonderful week. Welcome. If you haven't subscribed to the YouTube channel, please do that. Believe it or not, some of you are still not subscribed to the channel after all these years. I don't know how many years we've been going. 6, 7, 8. Goodness. Yeah, so what are we going to talk about today? Well, I'll tell you right now, it has been a very slow peer-to-peer lending time for investing, for news, for everything. So there's not going to be a lot of peer-to-peer chat today. But I would advise you to tune in because I pulled some really interesting letters from the mailbag, which I think you're going to really enjoy. And we'll talk about some other financial news about what's going on in the market. And we had a big loss today. We've had a couple of losses this week. Some pretty prominent people, sadly. And just goes to show you how short life really is. And people that I used to look up to when I was a kid are no longer with us this week. So Ozzy Osbourne for one of them. The famous rocker. He is no longer with us, so very sad. But anyway, we'll talk about some really good investing stuff. Tune in, write your comments, write your thoughts. Let me know what you think. Let me know if you agree or disagree. Not everything I say you will agree with. I'm sure some of it not. So hit that thumbs up too if you can. Should we say a quick hi to everybody? Sure, we should. Paul Bagworth in Kenilworth. Chimpo Naughty. Very cool. Cambridge. Did you go to Cambridge University, Mr. Chimpo Naughty? Peter Vince in a grey, damp leatherhead. Colin Perry in the Peak District. Invest24 is here. Stephen Hale from refreshing Nottingham. Send some of that refreshing weather over here. Please. Aki Chak is here from Accrington. Of course, always good to see you. And Mike Powell here too. I'm presuming it's down in Southampton. Let's get right into it. There's no sense in messing around. I'm going to take a quick look at the LoanPad stats because I haven't looked at them in a bit. And I wanted to see what was going on in LoanPad. So let me pull it up. Oh, but of course we have the Harley cam back. I decided to change it up this week since not much to see outside, but Harley is here. Learning about finances, which I think is cool. So, here we go. LoanPad continues to grow in the peer-to-peer lending space. £213 million, approaching £214 million in total loan value, with 273 live loans now. At this point, the average LTV still hovering just a little bit below 44.5%. Interestingly, average loan size still remains a little bit lower than the mid 400s, which is good to see. In total lenders, it's not really uptick that much, but 6,220. Main thing is we got 20 lending partners, and liquidity still the number one important, I think, factor of investing through LoanPad, with the estimated time to sell if you are in the classic account, less than 1 day. If you're in the premium account, which pays more interest, you're going to have to wait 60 days. And then get your money to work. Estimated time to invest, as it has been from day one, less than 1 day. Now with this 1p minimum interest amount to get reinvested, you got a little bit more compounding interest, which is good for a long term. Total number of LoanPad loans since inception. We're approaching 1,000 LoanPad loans. Imagine, so we started looking at LoanPad in 2019 when they launched. So now 6 years later, coming up on 1,000 loans with 702 being repaid. It's pretty impressive statistics. No, you're not going to get the highest interest in the world, but you're going to get what I consider a relatively safe peer-to-peer lending product that you can use for short term or longer term if you wish. I'm digging it. My money is still there. So let's take a little bit of news, not really peer-to-peer related, but Yield Street. And this kind of goes along with the letter that I got in the platform mailbag, in the peer-to-peer lending mailbag about investing money. Question where to invest. We have these new companies out here like Yield Street that are offering different ways to put your money to work. So Yield Street raises $77 million new capital for platform expansion. For those of you that don't know what Yield Street is, and that's 77 million pounds, by the way. Sorry, dollars, not pounds. Yield Street is a way to offer entry into private market loans. So things like real estate, art. You can see, I don't know if you can see this, it's small. Private credit, short-term notes, private equity, venture capital, art, diversified funds, and legal finance. So, kind of crowdfunding towards normal assets that you might not have access to. You can see here we got short-term notes, we got an income fund. I'm not signed up, so I can't see exactly what they offer, but interesting things. Kind of reminds me of the early days of peer-to-peer lending when you could invest in things like artwork and things that were not quite normal. Unfortunately, the platforms that we invested through didn't quite make it, but places like Yield Street are offering alternative access to things. So interesting. Let's look at Blackstone. This is kind of a jaw-dropping number to me. Blackstone profit jumps 25% as assets under management, or AUM, hits, get this, 1.2 trillion US dollars. That's a pretty incredible amount. In its latest financial results, the company reported total distributable earnings of 1.16 billion pounds. I mean, these numbers are they're just so big to me. 1.2 trillion US dollars under management. Just to give you an idea how big that is, the estimated total money supply in the entire world is about 100 trillion US dollars. So these guys, Blackstone, are managing 1% of the entire world's estimated finances. That's just mind-blowing to me, these numbers. Normal people are struggling to make 50, 60,000 pounds a year, and these guys are managing 1.2 trillion US dollars. Total revenues increased 3.7 billion, up from 2.8 billion over the same year. And this also goes to show just how much money people are investing through companies that offer things like private credit. Mind-blowing. I get really Google. I kind of nerd over stories like that because it's just really blows my mind. Also, another story on the Alternative Credit Investor website. Most compelling investments no longer on public markets. Almost all private market managers agree that the most compelling investments are no longer available on public listed markets. According to a survey by Wealth Club, 97% of private market fund managers said they think the increase in companies remaining privately held has meant public markets no longer offer the most compelling investments. Almost 46% said they expect to switch away from publicly listed markets to private investments, private company investments. Currently, around 88% of the 159,000 firms globally revenues over 100 million are privately held. So what does that mean? It's basically saying that people want to invest in companies that are privately held and not publicly held companies that you could buy stocks through, and stocks and shares. I think it's inherently more risky myself, but I've never been really one to go into that type of investing. But I think people are yield chasing right now. We've become so used to things inflating and stock market returns. Now you can get 10%, 11% in an S&P 500 index fund. People are looking for more. And they get these little carrots on the end of the stick with these private investments saying, oh, you can make 15%, 17%. Come on in, the water's fine. But that's only when things are going well. And for those of you that have invested through we're not talking about companies that are making $100 million a year, but we're talking about smaller SME businesses that places like Assets Capital used to offer investments. And those are private companies, right? As we saw, a lot of those companies ended up running into real trouble. So while the yield was a little bit better than what you could get through investing in, say, an index tracker fund, you also took on more risk. And when the companies failed, you end up making way worse yield return than you would have done just investing in publicly held stocks and shares. It's an interesting take. I'm not really sure I buy into it. I think there's other places to put money that can do better for you, including some peer-to-peer lending websites. But I feel a lot of FOMO when it comes to these private investments. Even just this website here, Alternative Credit Investor, now, there used to be a peer-to-peer lending website, right? Now, most of all the news stories that I see here are about private credit, which is the darling of the investment world right now. Private credit, alternative investments, private credit. So, just be a little cautious if you're thinking about getting into that type of investing, because I'm not sure that it's the best thing. Moving on, Cufflink. Do have a bit of peer-to-peer lending news, but Cufflink is offering a limited time summer rate boost. And I'm glad it is, because I was waiting. I've got some money in Cufflink sitting in the wallet. I was trying to figure out what I wanted to do. I didn't want to put it in the 2-year. So prayers were answered. Now they're offering, if you invest by 10 a.m. on Monday, 1st of September, this is not a plug. They did not pay me to advertise this. I just look at things and say, this might be a good place to consider. 1 year, now you can get a 9% interest rate for 1 year on the auto lend product. So you just stick your money in, don't worry about it, and there you go. 2 years, 9.5%, and then 3 years, 8%. A little bit more with the gross interest equivalent rate, because after year one, you're going to get compounded interest. So the money that you will earn from year one will go to year two. So you get that rate boost up to 9.95% gross annual. 3 years looks a little worse, obviously, because the interest rate on the year three product is worse than the year two product. So I think it's a pretty decent offering. I don't really like locking money up myself for 2 years. However, if I don't think interest rates are going to go really lower. So if you take a gamble and you think interest rates are going to rise, you might want to just stick to the 1 year product. I think this is a decent interest to be able to set and forget. You put your £500 minimum in, and at the end of the year one, you're going to have, what is that, £545 if everything goes to plan. So again, Monday, September the 1st is the deadline date for getting that new bonus rate. That is, let's see, summer rate boost for all Cufflink pool investments, auto and auto IFISA. So you can get it in the regular account or the ISA. So there's that. Let's go to the mailbag. We're going to skip right through. I'm going to try to move along quickly today. This is a really interesting question that I got. Hello, Sir Lawrence. Apparently I've been knighted, received a knighthood from the royal family. Greetings from Italy. This is a very random question for you. What's the worst financial decision you ever made in your life? I've recently made a very bad one. I wanted to see if you had made a worse one, which will make me feel better about my bad decision. Ciao from Antonio, British man living on the Amalfi Coast. Wow. What's the worst financial decision you've ever made? I've made a couple. Made a couple of bad ones. The first one that comes to mind, Antonio, if you're watching this, is 2000. Let's say between the period of 2005 and upwards, acquiring as much property as I could get my hands on for loan to value of 50%. So borrowing 50% of, which I thought was a pretty conservative thing to do, borrowing 50% on land, some condos, and a couple of houses. And then, of course, was it 2005? I don't know. I acquired them, a couple of years apart. So I think I stopped acquiring in 2007, of course, right before the financial crisis happened. And then everything crashed. The property values crashed. There were some condos that I had paid $100,000 for that went down in value to 30, and I thought they were never coming back. And the rentals were not covering the loan payments, and I just didn't see any particular way out. So that was some pretty terrible financial decisions. Another one that I've made, which kind of also goes into another question that I had this a couple of weeks ago about, listening to other people's investment advice, which is funny because I'm here giving you investment opinions. I'm not giving you advice. I don't want you to ever take my advice. Please, DYOR, do your own research. But one of the other financial worst decisions I ever made in my life was listening to a couple of people that are very close to me about investing. And those turned out to be very punitively harmful decisions. And I'll talk a little bit later on the stream about that. But I would say buying land, buying houses with too much debt was a very, very bad financial decision. And when real estate is good when things are good, right? When rents are healthy, when property values are going up, when your rents cover your loans, everything is good. But the problem is taxes increase, rents can sometimes go down, and as we've seen with real estate, property values can go down too. And the biggest problem about real estate is it is highly illiquid. If you want to sell a house or a flat quickly, you can't do it sometimes. I mean, there is the occasional rare, maybe instant where somebody comes along, wants to buy your property for cash and you can get in and out. But even then, that's not particularly fast. It's probably going to take 60 days. And yes, you could borrow against your property, but again, loans could be slow. I guess you could use peer-to-peer lending to get liquidity from a property, but is taking on more debt the best decision? I don't think so, and I speak from experience. Being leveraged, even low loan to value, can really hurt you. It certainly hurt me back in 2010 when I had to file for bankruptcy because I could no longer keep going with the loan payments for all the real estate that I owned at that time. I would say that's the single worst financial decision. Now I'm a lot more conservative in some ways. I take calculated risks. I don't borrow if I don't have to. And that certainly makes me more comfortable and able to sleep at night. But really cool question. Let's go on to the mailbag. Let's have another one. I hope you like these. I do. I think they're fun. Especially when it's a slow news time. Hi, Lawrence. I hope you don't mind me emailing you. I know you take emails for your live show. My brother-in-law has been telling my wife my brother-in-law has been telling my wife that he thinks the stock market is going to crash soon and that we should take our investments out. This has made my wife very jittery, and now she wants to speak to a financial advisor and find out what to do. I really don't know what to do to calm her down. I was hoping you would answer this question so I could show her the video. Any advice would be greatly appreciated because this is extremely stressful. Grateful viewer for 5 years, Keith. Yeah, this is a good one. So this kind of goes back to this other email that I had about the worst financial decision, where I said listening to other people caused me to make a really bad financial decision. Um, Whereas I was listening to very close people in my life who were telling me about, oh, it's probably 3 years ago, the stock market was going to tank and cash is going to be king, blah, blah, blah. And yes, were they right? Well, no, it didn't crash. We had a downturn in April of last year. Was it this year? I can't remember. I think we had a bit of a dip in 2022. We had a dip this year, but it was very brief. And being out of the market when I decided to listen to these people and sell a lot of the money that I had invested in index trackers to sit in cash. I didn't do it all, thank goodness. I said, no, you know what? I could do 50% of what I had in the markets and sit out. The problem is I ended up sitting out for a really, really long time, and I watched the stock market bounce back. I didn't go in when the market dipped because I thought it was going to go lower, and the people were telling me, the two people, oh, this is, disaster is coming, and I think I told you guys on the stream a couple of times that I thought the markets were going to go. It seemed like they were going to go. Everything was pointing to financial disasters, but nothing really happened. Aside of those couple of dips throughout those 3 years from 2022 to 2025, sitting out was so extremely punishing, from the amount of money lost, from the upticks in the financial markets that I missed out on. So I think it goes to say that this letter is really pertinent to my own personal experience about listening to other people, and even experts. They get it wrong. They get it wrong all the time. I don't know if your brother-in-law Keith is an expert. Probably, I would say probably not. But the answer to this is we don't know if the stock market's going to crash tomorrow or in 10 years. I mean, it's certainly been very, very buoyant, very, very good. And there's a great saying that dead people make the best investors because they don't change anything. And I think that's the best thing. If you've got time, if you're retiring in a year, something like that, the right play would be to move into conservative investments to protect your capital. That's the most important thing. But, if you have time, if you're in your mid-40s, I don't know how old you are, Keith, you don't really say. But if you're in your 40s and 50s, you got time. You got 15 years before you retire to ride through those ups and down times. So I would tell your wife, look at an S&P 500 chart or a stock market chart and say, this is what the charts have done historically, even when markets have corrected naturally over the next period. Usually corrections, they only last downturns about 9 months historically. So just leaving your money and being able to let the markets correct themselves naturally and then recover is the best thing to do. And besides, if you go out of the market, you're going to have the experience that I had, which was not knowing when to get back in and then sitting out way too long and losing possibly years of appreciation on your investments. It's pretty simple. People do get jittery, especially when the market's correct, then they tend to sell at the wrong time. People get the jitters, I get it, but that would be my advice to you. And there's nothing really pointing to the fact that the stock markets are moving to correct, and we've got very positive new economic news stories coming out of the U.S. Even to a couple of days ago, the EU, right here, the EU and the U.S. are close to a trade deal, setting 15% tariffs on European imports to avoid President Trump's planned increase to 30% on August 1st. That's bullish news that will make the stock markets happy. Japan just agreed to a trade deal that still involves paying a 15% reciprocal tariff, requires a $550 billion investment in the U.S., 90% of profits from investments go to the U.S. Again, positive financial news. And then also, you're still suffering from inflationary issues. The CPI June inflation in the US was 2.7%, but look at some of these: gas utility inflation plus 14%, car insurance inflation plus 6%, electricity inflation, meat and eggs inflation, all of this, rent inflation almost 4%. So inflation going up, that is not particularly good, positive news, but what it does is it means you can move into alternative investments that are inflationary protected, like our friend Mr. Bitcoin and things like that. So is that going to affect the stock market? It doesn't seem like it has, because people are focusing on this 2.7% inflationary number, which people seem to think is low. But look at this. Rate cuts remain distant. Rate cuts remain distant. So that generally means that people will still invest in equities. Moving along, another letter. This is a really good one too. Hello, Lawrence. Hope you're doing well out there in sunny Florida. I am. Thank you. I think I remember you speaking about your experiences with buy-to-let properties in the UK. I just had a windfall in the form of an inheritance. Everybody said I should buy a rental house, but I'm not so sure. Where I live, property is quite expensive and rental yields aren't great. Do you have thoughts on this? Perhaps what to do with the money if I didn't buy a BTL, buy-to-let? Thank you as always, Malcolm. Yeah, I do. I have a very personal experience on buy-to-lets, having owned partial shares in 2 buy-to-let properties between 2020 and 2024. When I did the calculations, Malcolm, in the South, where yields are not high, properties are expensive, yields on the rentals were not great. They were about 3%. How could that be, you ask? Well, landlords honestly are not very realistic about what they're truly making on paper. I speak to people who tell me, yeah, I make 7% a year on my rental properties, and the problem is most of them bought them back in the 1990s when the prices were a lot cheaper. But the people who bought them in the 2010s, it'd be like 2015 onwards, when the market dipped and then really started racing up, those people are not very realistic and not truthful about how much money they're actually yielding from buy-to-lets. And I think the real number is more true, especially in the South. If you live in a property of high cost of living, where properties are expensive, I think you're yielding a lot less. And when I ran those numbers on the 2 properties that I had shares in with my family, I was getting about 3.5% a year, and that includes the increase on the property price itself, which had gone up a little bit, rental income, but what you don't take into factor is how much the repairs are going to be on an older house. If you can buy something new, this isn't so much of a problem. But if you're buying a house that was built in the 90s, the 80s, the 70s, boilers go out, extensions leak, plumbing leaks, you have electrical problems, all these different things, things need updating. When you buy a house, right, a buy-to-let is 20 years old and it hasn't had anything doing to it, eventually you're going to have to renovate the property and remodel. That costs money. That's what I found we had to do to update it, to keep it fresh. So people wanted to rent it. We had to do a new bathroom. We had to fix the leaks in the extension, and that's why the yield is only 3.5%. So after running it for 4 years, I ran the numbers, I ran the real numbers, and I said, you know what? And we bought those properties for about a little bit under retail. They weren't super expensive, but just the rents weren't that high for that type of property. And there are cases where you can get really good deals on buy-to-lets. I think they're hard to find. Your average investor is not going to go out and buy a £300,000 house for 200 grand unless it needs a ton of work. It just doesn't exist. It's hard to find unless you're a professional and you know how to do that. So I'm not a big fan of buy-to-lets buying at today's prices, even just 2 or 3 years ago. I think you can get rid of the headaches of buy-to-lets by taking that money, especially if you've got an inheritance, and just investing it in other places. I think you can get better yields in the stock market. I think you can certainly get better yields in Bitcoin for sure. I mean, that's kind of a no-brainer to me now at this point, even though we still have these naysayers who will say, Bitcoin is a Ponzi scheme, whatever. That's up to you to decide. Do your own research, not financial advice. But I personally will not touch another buy-to-let property. And then with the headaches of the tenants too, you have that factor of tenant unknowns that you just don't know what a tenant's going to do. And I can tell you, it's great having a rental management company taking care of tenants, but they don't always have your best interests at heart. That rental management company is not going to take care of your property like you are. And sure, they get the call in the middle of the night if they respond. Sometimes they don't. The toilet's leaking, the pipe burst. Does the rental management property respond quickly? Sometimes not. Sometimes it can take them a few hours and damage is done to the property. So, by the time you pay a rental manager, and the tax, by the way, that you're going to get taxed on. Yes, there are some tax advantages through buy-to-lets, but you're going to get taxed and you just don't make as much money. There are places, like I said, where you can invest money without the headaches of landlords. Property prices. Look at this. This is an interesting. This was on Crowd Properties State of the Market that they sent out. UK house prices were steady in June, 1.6% year-on-year increase. So there is a little bit of capital appreciation on house prices. Not great though, right? 1.6%. So you're not getting a big yield on that. Of course, there's places in maybe Northern Ireland or in the north of England where you're going to get better yields and better increases, but some people don't want to invest in those types of places. So house price index not looking all that great for the increase in appreciation on prices. So I just think there's better places to put money right now without the headaches of being a landlord, which, sure, there's some landlords that love being a landlord. I didn't love it. I didn't like the return on investment was really low. I could have just put the money into LoanPad and gotten almost double the yield and probably paid less taxes. And the stamp duty too, that kills you. I mean, the government's just really hammering on landlords with the stamp duty, so you end up having to pay more on the property because of the stamp duty. And God forbid you need to move your property from like a limited company into your own personal name, you get hit with the stamp duty twice. So that also can really dampen the returns that you're making. Where can you put money? I mean, obviously, index tracker funds, you got peer-to-peer lending, you can put it in Bitcoin. There's plenty of other places. You can keep it simple and not have to worry about toilets leaking or getting blocked up with poo. Let's look at the trading 212 portfolio. We are down a little bit, sadly. We've dipped again under that 30,000 pound portfolio that we finally hit over the 30,000. Here is our high point, the 30th of June, 30,389. We're a little bit under there now, 29,961. Why is this not letting me scroll down? Come on, there we go. What happened? We've had a bit of a dip in MicroStrategy where we have almost 1/3 of our portfolio. There you can see in the last week we're down about 8.47%. Volatility is our friend. It happens. And then here, S&P 500 last week, 0.5% increase. NVIDIA's been doing really well. We're up 70% on that investment now. 1.34% last week. Amazon had a good week, 3.9% increase. And then our good buddy Elon had not good reports on, I think, the earnings report. I don't know. I never looked at the Tesla earnings report, but I'm presuming it wasn't great because the stock is now down again. So it looks like we made a good decision dumping half the Tesla shares a few weeks ago, because right now it's back to 304. I think that was where I sold at. So yeah, but the portfolio is still doing really well for now. Yeah, speaking of alternatives, look at the Bitcoin price right now, 118,946 US dollars, 81% year, 1 year return now. 81%. You cannot get that in real estate unless you're extremely lucky. And just in the last month, 12% in the month, red hot, 25%. As things like these inflation reports come out, right? Inflation is a killer and makes things like Bitcoin do well. These inflation numbers in the US, gas inflation, everything is getting more expensive. The only thing that I've seen go down here in the US is petrol prices, to be honest. But everything is going up, and money continues to get printed. So Bitcoin loves this type of economic situation going on in it. There's more and more and more money coming into this space that people continue to ignore. And one of I think Charles Schwab said they are going to be creating Bitcoin and cryptocurrency products. They were on the news. They are going to launch Bitcoin and Ethereum trading in 12 months. Schwab is huge, 10.7 trillion in assets under management. So this company obviously sees that this Bitcoin is not going away. They are going to launch trading, which shifts away from their standard classical shares under management, index funds and things like that. 10.7 trillion under assets in the US. And worldwide, they are going to be, I think, launching their own exchange-traded funds for crypto products. Anyway, the point is, this is not going away now. People can keep on saying what they want. Yes, it will always be volatile, probably. But Trump's crypto company has just announced $2 billion in Bitcoin buys to hold as treasury, so they're no longer going to be holding $2 billion in cash. Smart move by them, because they understand inflation is eating cash away, and you can't make any money on it because yields suck. Even if you have $2 billion in cash, you can probably only get about 4%. They don't want 4% when they're seeing these high numbers of 12% a month, 82% a year, and 87,967.5% returns since Bitcoin was launched in 2009. So, there's obviously plenty of places to put money nowadays where you can make better than 3.5% in real estate. Is it going to be as stable? No, of course not. If you don't have stomach for risk, this is not the place for you. But look at this. The Financial Times says that Donald Trump is set to open U.S. retirement markets to cryptocurrency investments. He has preparing a executive order to allow 401k plans. Those are U.S. work plans that you get through an employer. In the U.S., if you invest a certain amount of money, there's a lot of employers will match that. So you put in $3,000, they'll give you $3,000 match for the year. And typically you haven't been able to invest in things like crypto through 401ks because they're largely regulated, but Trump is going to change that. Well, what's going to happen? This is kind of a no-brainer. This is news that's right in front of our faces saying, once that happens and people can invest in things like Bitcoin in their 401k, more money is going to move away from equities, index funds, and is going to go into a broad pool of alternative assets, as it says in the Financial Times, which is going to make the price go up. It's not rocket science, people. This is all happening. It's going to happen everywhere in the world. But $9 trillion U.S. retirement market will have that as an option. And I saw this really good tweet on Twitter this morning, and it just really struck me. And I think it's something that I wanted to read. Oh, because look at this. Today we lost the legend, the wrestling legend Hulk Hogan died at the age of 71, cardiac arrest in his Florida home. Poor guy had a heart attack. It's funny about Hulk Hogan. When I was a kid, I used to love Hulk Hogan. I used to watch the WWF. And the funny thing about Hulk, he always looked old when he was young. You look at these pictures from 13 years ago, and he still looks the same, right? When he was, this is back in the 80s, and he still looked like an old guy. Probably all the steroids. But anyway, he died, unfortunately, at 71 years old. Well, but this tweet, I'm just going to read it to you because I think it's super important. Time allocation is now more important than capital allocation. Capital allocation is a solved problem. Just buy Bitcoin, not financial advice. You can insert whatever you want in there. Just buy index trackers, whatever. This one is about Bitcoin. Just buy Bitcoin and hold it until you reach escape velocity. What does that mean? Escape velocity means exit. It means exit for retirement. The left and right sides of the bell curve understand this, but time allocation, this is an evolving field of study. Personally, I'm baking some unique assumptions into my time allocation decisions, assumptions no one in human history has ever had to navigate, namely that AI will completely upend the world as we know it inside of 10 years. There will soon be an abundance of tireless intelligence that exceeds the capacity of the smartest humans on Earth. AI will be solving humanity's biggest challenges around the clock. That seems entirely reasonable to me. And 10 years is probably a conservative timeline. I think that's a conservative timeline. Elon Musk just has opened a AI factory. It's huge. I think it's 200,000 GPU computers with the biggest supercomputer running X's AI. This is going to happen in less than 10 years. He has another, it's called Colossus, another AI plant. It's going to have 500,000 computers running in it within, I think, the next couple of years or a year. He does things fast. Anyway, continuing on. Even if you completely discount the emergence of a recursively self-improved superintelligent, you should at least consider the possibility that 90% greater of all paid mental work will disappear. This means we're getting replaced. There will be a vast societal and economic consequences. Life 10 years from now could be far better or far worse. We don't know. The optimist in me chooses to believe it will be far better, as fewer people will be wasting time on menial work, and the price of things will fall dramatically when priced in Bitcoin. But how should you act if you believe the world will change in an extreme way within the next 10 years? Everyone is in different situations. Personally, I'd do everything I could to get as close to owning one Bitcoin as possible within the next 3 years. But if you're already in a solid financial situation, you should probably add a much larger premium to your time than you already do. That's what I'm doing. We are living in a golden age that we will look back on with extreme nostalgia, similar to how many people look at the time before the internet as a special time, but times 100. There'll be no mass reliance on UBI. I don't know what that means. Opportunities for upward mobility still exist with hard work and ingenuity. No autonomous face scanning police roaming the streets. Most places are still safe and place to visit. Are you soaking it in? Are you experiencing this time fully instead of living for the future? As I consider how I want to educate my children, it's obvious that the current system isn't set up for the world that's coming. 20th century jobs as we know it will disappear. Worker drones will be useless. So instead of inculcating, I don't know what that means, the habit of daily mental work and prioritizing the next grade or the next milestone, etc., as he was trained to do, he's going to raise his kids who know how to enjoy the present. I will encourage their natural ability to live with energy, enjoy today. I'll teach them value, mental, physical, and spiritual discipline. They will dance, laugh, explore, and love. They will do strenuous physical activities, blah, 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 play sports and art. And rather than prioritize more financial wealth, I will do these things with them along the way, because I now view this is the best way to allocate time to prepare for the likely future. And if I'm wrong, the beauty is I'll never regret these things, no matter what happens. Study time allocation, consider the future we're headed towards, and adjust accordingly. And there's a picture of a Citroen 2CV. Look at that. Which maybe this is in Greece. I don't know where this picture is, but it looks nice. So what does that post mean exactly? What I break it down to is time is the most important thing we have. I'm now 52 years old, and I've worried about finances my entire 40s, focusing on accumulation and will I have enough money to retire? Am I going to be broke and homeless, working at Costco as a greeter? And this article is basically saying if you're able to acquire the right assets, this article speaks of Bitcoin, but that could be whatever it is for you in your opinion. If you're able to acquire those correct assets now and in the next 2 or 3 years, you probably will not have to worry about accumulation anymore. And then you can focus on time, spending time with your family, working on your health, spending time doing things that are important to you rather than focusing on, what peer-to-peer lending site should we be investing in, and is Tesla stock good? And this AI conversation, if you don't use AI right now, then you won't know this, but AI is replacing people. There are people who used to make a really good living at writing articles online for things like website optimization, and those people are getting replaced by AI. AI can spit out an extremely good article that is unique, and it can do it in a couple of seconds, and it can do it for free. These poor people that are getting replaced, things like writers, website writers, SEO optimization people, they're getting replaced by AI. This is happening right in front of our eyes. Every day you can see it. So what this article speaks of is true, and I think extremely powerful. So, lesson here, I think, value your time, because we, like Hulk Hogan, who has now passed away, and Ozzy Osbourne too, and I think somebody else died this week in a swimming accident. I can't remember who it was. I heard about that. Let me look. And I think he was young. We had the Liverpool guy who died in a car crash, right? Oh, here we go. Malcolm Jamal Warner, 54 years old. You might not know who he is, but he was an actor on The Cosbys, the American TV show. He drowned while swimming at 54. The point is, we don't know how long we have left on this earth. Time is everything. It really is. I just want to look at those Tesla earnings because I didn't see them yesterday. Let's see what it said. Why has Tesla stock been really struggling? Well, we all know Mr. Elon's a twat. Aside of that, let's see, down 12% the last month. So here's the earnings. 9% stock plunge. That was a weak quarter for auto sales. 16% decline in auto revenue from a year earlier to $16.7 billion. Total revenue fell 12% to $22.5 billion. Tesla's been facing rising competition in key markets like China and Europe, especially from lower-cost Chinese EV players. In early July, Tesla reported a 14% year-over-year slide in vehicle deliveries to 384,000 for the second quarter. And in Europe, Tesla's new registrations declined last month. The stock's down 25% in 2025. In the U.S., they are ending the federal tax credit of $7,500 if you buy a new electric vehicle, you can get $7.5 grand back on your taxes. They're ending that in September. That is going to hurt Tesla even more. Tesla is way more than a car company, though. And, this whole thing about the protests against Musk, I understand it. Personally, I got my own views and not going to get into that, but they make a damn good car at the end of the day. If you've ever driven one, if you haven't, they make a really good car. Some of the older cars, not so good, but even the new ones are just better quality vehicles, and they are fun to drive. And they can drive themselves here in America. You hit a button, and this thing can, for the most part, take you from A to B without you ever having to touch the steering wheel. And that's going to keep on getting better and better. I don't know if Tesla stock is going to do any good anymore. It's hard to say. I would imagine we'll look back in 10 years if they can survive the problems that they're having right now. Yeah, stock will probably be way higher than it is now. I don't have a crystal ball. That's not true. I do have a crystal ball. I don't know where it is. Where is the crystal ball? Oh, here it is. Here's the crystal ball. It's still here. This has been ever faithful and useful over the years of sitting on the desk, but it still never tells me the answer to the questions that I want to know about. I want to know, is Tesla stock going to be $1,000 in 2 years? It just doesn't tell me anything. It doesn't tell me anything. I don't know. Nobody knows. That's the real answer. Anyway, what time is it? It's 8:21 p.m. in the UK. How's the weather? Is the weather bad everywhere? I don't know. Let's take a quick look at your comments and we're going to get out of here. Another platform went bust. Who went bust? I didn't hear. Who went bust? Tell me. Mike Powell. Come on, tell me. Who went bust? I'd say it's been quiet, but this week we've had loans available from Propland, CrowdStacker, X2, CrowdStacker times 2, Capital Rise, and Axia. Yeah, there's been a ton of loans. There's always plenty of peer-to-peer loans. Blend, I see them come through my emails all the time, but I just don't see a lot of interesting news. I don't see, even when I go to the peer-to-peer independent forum, right? Let's see, peer-to-peer. There's just not a lot of activity. It's quiet. I go to the general discussion, the P2P forum, and I'm looking at the same posts. Why is the peer-to-peer sector not larger? There's our Chimpo Naughty. Look at that up there. There's just nothing really interesting here going on at the moment. So it's quiet. But yeah, there's plenty of peer-to-peer lending loans out there. Fund Ourselves went bust. I've never heard of them. Who is? Let me look. Fund Ourselves. Smarter peer-to-peer borrowing. Oh, their website is down. Okay. Fund Ourselves enters administration right there on the FCA's website. Did anybody have investments through Fund Ourselves? I didn't. I missed one finally. I finally missed one that went bust. I think I caught all the other ones. So, yay. Good cufflink loans this week. Shodan struggling. I don't know if that's true. Rip Hulk Hogan. I purchased some Solana and Ethereum this week. Hopefully that's a good move. Oh, I don't know. It's Ethereum, by the way, I didn't mention this. Ethereum has been on a complete tear. Ethereum had done nothing for a while. Now it is ripped up to 3,700. Look at this. Look at this dump. So we were in April of 2025. Ethereum It's 1,555 US dollars, and now has sprung all the way back to 37.58. That is crazy. 1 month, 54%. Is completely overheated. 108% in 3 months. It's doubled. Crazy. Crazy. Any thoughts on farmland REITs? I'll be honest, I don't know enough about farmland to get into that kind of thing. I think farming is extremely volatile. Too many government subsidies and government hands in the pot when it comes to that. So I personally wouldn't touch it. When should we write a book on the first massive crypto scandal hits the retirement industry? Hey, could happen. You could write that book, Mike. Lawrence, have you ever done share lending on Trading 212? It gives you 50% of the interest received by Trading 212 for your lent shares. I'm thinking about doing it. I did look into it. Invest24. I did look into it, and it doesn't come without risk. I do know that if you lend your shares out, I think the risk is that if the person borrowing defaults, because what they're doing, I believe it's margin investing. So I think you're lending to people who want to leverage. And I think if they default, you have a risk of losing your shares from what I understand. So yes, you can make money at it, but it does come with risk. So let's see here how it works. We lend shares from your portfolio to borrowers and receive interest in exchange. So it's like a loan. We split all interest equally with you. Shared lending is fully automatic and will never cause delays when selling. You still get paid dividends in full. Secured by collateral. All shares, lent shares are secured with U.S. Treasuries. The collateral minimum is 102% of shares value. The collateral is adjusted daily. Fully automatic. No restrictions on your trading. Complete transparency. No commitments. You can take 2 days to get out of it. See how much you could earn. What is this? 0.86%. That's annual, right? So some of these shares are just not paying much. 3.55%. Oh, goodness. So it says 7.3%. I don't know how much. So value of shares lent. So if you do it for a year, you lend. I'm trying to find a share that's like a popular one. Yeah, okay, let's look at Nike. You lend it for a year, £300, you're going to get 12% interest. So this is the amount of interest you're getting a year. You put 1,000 in, you're going to get 40p. I'm just not seeing a lot of good yields here for the... Okay, LAES, I don't know what that was. 7%, that's going to give you 75.72. I want to see what the risks are. Here we go. The borrower doesn't return your shares. Your shares are secured by collateral in the form of U.S. Treasuries, protected as any other client investment. Intraday price volatility. So yeah, if the shares start to tank and you want to sell them, you can't because you're locked in to 2 days to get out. Trading 212 goes bankrupt. Yeah, that's always a possibility. I guess I'd have to look into this. This was my number one biggest risk, that the borrower doesn't return your shares. I don't know about this safeguard. Your shares are secured by collateral in the form of U.S. Treasuries. How does that work exactly? So what if the borrower doesn't return your shares? It doesn't really tell you what happens at that point. So, yeah, I don't know. I don't like the idea of not being able to exit if I need to. Although I usually don't tend to make quick decisions with shares. anymore, so it's not necessarily a bad thing being locked in for a couple of days. But I don't know how much it does. Let's see, can I find out how much I would get if I were to lend on, say, MicroStrategy with 10 grand? How much would I receive? I don't know how to see what the That's some interesting things here. Now look, automatically invest your spare change or cash back into MicroStrategy with your 212 card. That's kind of cool. By the way, MicroStrategy is having an earnings report on July 31st. I think their earnings are going to be huge. I expect this stock to pop upwards. I think they've made something like $600 million in the last couple of weeks through just holding Bitcoin. It's crazy. But yeah, I don't know how much. Let's see, explore interest, earn interest. How much am I going to get? None. There's no demand for that. Can I lend on this S&P 500? So, earn interest to see how much I can get on the tracker. None. Let's see what the most borrowed is. I mean, even these ones that are most borrowed, the interest rates are just so low. Do you own any of these? That's the question. I don't own any of these. Those are the most borrowed. Open Door Technologies, 3%. I don't know. It's not worth it. 0.7%. So I think my answer to that is probably not for me. So maybe for you. Check into it. How much does Apple pay? See how much you can earn on Apple. None. There's no demand. So that means people are not borrowing. They're not using trading 212 much to borrow against blue chips. Oh look, we just popped over 30,000 on the trading 212 again. Let's see. So my answer to that, no, I would not. Chinese make better electric cars. I've been in a Chinese electric car and it sucked. The quality was crap. Michael Madsen died too. He was in Reservoir Dogs. Oh yeah, I heard about that. Sad. Fund ourselves used to be Willendas. Oh. Yeah, I looked at Willendas and they had a very small portfolio. And I always said I don't understand how these companies can survive with a £12 million portfolio. Great rates, terrible communications and website. Everyone I know bailed. Yeah. I see. Yeah. So I would say trading 212 would be a no for me. Do your own research. Anyway, I'm going to get out of here. Holly she needs a walk. She is busting at the seams to go outside. Hit that thumbs up if you have not already. Please. That's all I ask. I give you an hour of my time and several hours of research, and all I ask in return is you hit that thumbs up to tell YouTube that we are doing a good job. And thanks so much for joining. It really means a lot. I'll be back likely in a week, all being well, and I'll see you next time. Have a great weekend. Enjoy the hopefully sunny weather that I'm sure will be coming down onto you soon. And I'll take care. That's all I got for you this week. See you next time. Bye-bye.